This is Bloomberg.
25 seconds away from the opening bell in New York this morning. Good morning to you all. Your equity market set up as follows. Negative, just 0.02%. Pretty much dead flat on the S&P, and the Nasdaq 100 negative about 1/3 of 1%. Positive on the Russell by about 1/3 of 1% also. That's your opening bell in New York. Switch at the board and get to the bond market. We look like this in the Treasury market. Yields just a little bit lower. Well, let's call it a basis point to 289.31. Crude totally unchanged at 115.35, even with that increase in output over at OPEC Plus for July and for August. An upside surprise that you would think would have an effect, but apparently not. We can talk about that a little bit later. Through the day on Bloomberg TV and radio. In the FX market, tons to talk about with Microsoft very much in the hairs of all of this. Euro dollar 107.04, positive 0.5 of 1%. Stronger euro today, but weaker euro the story of the year so far. That's the cross-asset price action. About 30 seconds in. Here are your movers. Here's Abby.
John, well, we do have a little bit of a wobbly open for stocks, as you were just pointing out, but one mover to the upside, although it's off of its highs because of that Microsoft pre-announcement, Amazon. Amazon now trying for a 6th up day in a row over the last 5 days, gaining by 14%, and actually now it's flipped ever so slightly lower. Let's see if it can regain its momentum that it's had over the last 5 days, narrowly avoiding that 1 trillion mark to the downside. There hasn't really been a fundamental reason for this upside, but investors want in on Amazon. Let's see again if that continues today, where they are certainly going today. Chewy up about 14%. This after the company put up a great quarter. They beat on important metrics, including EBITDA. It seems as the pandemic trends are staying in place, at least for Chewy.com. Pinterest, not so much, down about 0.6 of 1%, cut at Piper Sandler to a neutral on slowing digital ad spending. And then finally, ExxonMobil down 0.6 of 1%, but off of its lows. This, of course, after OPEC Plus did just announce that output boost for the next couple of months, which has been dragging on oil, as you know, John.
Abby, thank you. One stock to look at, Microsoft, down 3.8%. The company pairing its earnings and revenue forecast. The company issuing the new guidance to, quote, help investors understand the impact of unfavorable foreign exchange rate movement in the fourth quarter of fiscal 2022. On the West Coast, Ed has more. Morning, Ed.
Yeah, good morning, John. This is a rate story, isn't it? This is a rate story, but not the one that I was expecting to discuss in the context of tech. The impact is $460 million in the fiscal fourth quarter, the tune of. And as you said, there's a revision. It's a more modest revision than we've seen from others in this earnings period. But in the quarter, earnings per share to be $2.24 to $2.32. That's down from its previous estimate in April of $2.28 to $2.35. Also a slight revision in the revenue forecast for the coming quarter as well. It was only in April that Microsoft painted this very bullish image of robust demand, particularly in cloud, strong earnings outlook. But again, they're part of this broader story. Revisions, the world is changing. I'm also keeping an eye on shares of Meta, the parent company of Facebook, up 1/10 of 1%. You have heard the news that Sheryl Sandberg, the COO, is leaving the company after 14 years. The other area really to watch, HPE. This is a fascinating story. Demand, very strong, but supply chain impact and the impact from Russia leaving that market gives a one-time hit to the numbers. It's an interesting one, right? We're still hearing that demand story is intact. HPE, of course, the seller of enterprise hardware, very good barometer of corporate spending, but they're leaving money on the table because of those supply chain disruptions. I like this story, John. I'm a nerd. I'm a West Coast guy. I like the history of how they split the consumer and enterprise businesses. And since that point, the consumer and the PC side has really outperformed. But what I'm hearing in this earnings season is that enterprise spending is still there in pockets, and that's where we want to look.
What happened to your Welsh roots? You're a West Coast guy. What happened, Ed?
Welsh roots, London accent, West Coast guy.
Ed, thank you, buddy. Thank you, mate, as always. Looking at crude too, positive 0.4 of 1% on Brent crude, 116.80 on WTI, 115.88, also positive there by 0.5 of 1%. Two headlines in the last 10 minutes or so, kind of building up to this moment in the last hour over at OPEC Plus, agreeing to hike output by 648,000 barrels a day in July and in August. That was more than was expected, and still we pull back from the losses from earlier today. Then on top of that, just moments ago, the EU approving a partial Russian oil world ban. No big surprise there given the direction of travel. Big surprise from Jamie Dimon yesterday. A warning for the banks and a warning for JP Morgan. Shunali Basak with us in the studio. Morning, Shunali.
Morning, John. You do have that gloomy outlook that you had over from Jamie Dimon over at JP Morgan, those storm clouds on the horizon. That on the back of that, you had a 4% decline on the S&P 500 Banks Index. Today, starting the day flat once again as the economic outlook gets pretty dire. Even though JP Morgan and Bank of America had talked about the consumer holding up, remember, some of the pain is elsewhere. He talked about the Ukraine war. He talked about quantitative tightening. He said to the extent that you see panic selling this time around, the banks are there in a lesser way than they were last time around as they have stepped back so much from markets. You have private markets stepping up in a bigger way here. Remember, the consumer being strong, what about the buy side? You had that massive scoop again this morning about Tiger Global tumbling 52% this year, and also other hedge funds really facing some pain. Bloomberg's hedge fund index shows you that equity hedge funds are down more than 7% on the year so far. So more pain to be had. Jamie Dimon calls it panic selling. The question is, will there also be forced selling, John?
Shunali, is there something self-fulfilling about the words of Jamie Dimon, though? When he starts to worry about storm clouds and they start to tighten lending standards, is there something self-fulfilling about what could happen with this cycle? That's
a good question, because in the background, the conversation I've been having with fund managers is that pain you're seeing in public markets are now getting into private markets. And that's where you did see a lot of the dry powder step up after so much fundraising. Now, will there be a broader step back in risk appetite? You are starting to see it. Do you continue to see it in a bigger way?
Shunali, awesome. As always, Shunali Basak there on top of the Wall Street beat. The story of the stock down about a third of 1%. Yesterday down by 1.75%. Katie Lyons, keeping up with this one is really difficult.
Is it, John? At least not in terms of tracking the bears and the bulls in this market, because they've actually remained quite consistent. You can pretty much always count on Marko Kolanovic over at JP Morgan to be on the bullish end of the spectrum. That's still where he is. He thinks that this market is going to be able to claw its way back from the losses we've seen to end essentially flat on the year. That would be about 16% upside from where we are now, because he says it's all been priced in. This market is already used to the idea of an aggressive Federal Reserve. And on average, strategists are actually more on his side. The median target for year-end still around 4,800, which is about 700 points north of where we are now. Mike Wilson, on the other hand, again, this really is no surprise, is on the bearish end of the spectrum. He thinks we're going a whole lot lower because growth is slowing and earnings estimates are too high. He says the S&P 500 will trade close to 3,400 by the end of the second quarter earnings season in mid-August, which is another 700 points or so lower, about 17% downside. Now, of course, we've already seen a 14% decline on the year so far, and looking back over previous times in history where we've seen similar losses between 10 and 20%, it's happened 29 times. On average, it has taken the S&P 500 just 4 months to recover. Now, if the decline is between 20 and 40%, the recovery time is much longer, about 14 months, and of course, the COVID drop of 33% took less than 6 months to bounce back from, so there's certainly outliers here. And of course, John, those numbers are from the bottom. And we don't know yet at this point if we've already seen it. We don't know how deep this particular route will ultimately be, John.
Katie Lyons, thank you. Teeing up the conversation with Chris Harvey of Wells Fargo. Chris, always great to catch up with you, mate. Let's start there. Can you call a bottom in stocks without calling a top in yields?
No, I don't think you can, but I think that's what's just happened, right? So we bounced because what we saw is the equity market could not handle a 3% 10-year yield. And so the equity market actually acted like bond market vigilantes. It brought yields down, right? And now we're below 3%. The market's bounced somewhat. You're having the funding markets beginning to work again. Credit spreads have tightened. I think we saw $15 billion of IG issuance yesterday. I think we're going to get 4 or 5 deals on the high yield market today, and things are okay. They're beginning to improve. The system's beginning to work, and value has been uncovered to a certain degree.
One thing you've said, Chris, is to look to the bond market, but look to break-evens. That's what you're using now to guide you. Is that helping things?
Yeah, it is. We're encouraged. So we had a portfolio. It was a growth at any price type portfolio. It was a group of names that we want to be short or we wanted clients to avoid. It was down 45%, 50%, I think, at the max. And when it was down 45% and real rates were above 1%, we said, okay, that's about it for this. We think a lot of the bad news is priced in. Our catalyst with real rates has played out. But more importantly, the other catalyst to get positive on growth break-evens had come down to our level of 250 to 275, indicating that we are coming off the boil with inflation, and inflation expectations are coming down, again, to a degree.
Chris, one thing I'm struggling with, others too, is getting a read on the consumer. We see consumer sentiment quite depressed, decade lows if you look at UMich. Then you hear from the airlines, they say things are great. You hear from the retail players, they say things are terrible. Chris, which one is it, and just how is the basket, the consumer basket changing? How are you tracking that, and what does it mean for how you allocate capital?
John, it's a great question, right? Because you really do have to understand what the consumer's doing. So a year ago, the consumer was completely price unconscious. They would take any price you gave them, and they'd say, I'll take 2, I'll take 3. Now what the consumer is doing is they're saying, okay, I find value in a certain way. And what we're beginning to see when they're buying things, right, when they're going to the store, they're hollowing out the middle. They have to spend more on the day-to-day stuff. They have to spend more on your staples, but they also have the ability and the want to spend up cap. They want to spend on big ticket items. They want to spend on the higher end. And what's happening is the general merchandise, the stuff in the middle that they already have tons of, they're avoiding. That also means is what we're seeing is a shift, and we've talked about this a ton of times and lots of other people have. You're seeing a shift from things to to experiences, excuse me. And so that's one of the reasons why the airlines are doing better. People want that experience back. They're willing to pay for it. And for now, they have the ability to pay for it. And so you're seeing just very different consumer behavior. The consumer spending, the consumer has the ability to spend, but now they're changing their choices. And what they're doing is they're going high end and low end, and the middle is being sacrificed.
And Chris, in the meantime, the C-suite struggling to gauge where demand ends up. Retail's a great example of that. I want to work through this with you because I think it's really important. Whenever you have a positive demand shock, what often happens is it takes a long, long time to ramp up capacity. You can think of the shipping industry a couple of decades ago. The duration mismatch between the demand now and the time it takes to build out capacity and bring on the supply online further down the road. Often what happens is you get a shock, the wrong kind of a shock, and you end up with a massive capacity overhang. Saw it with shipping, saw it with mining coming out of the last decade with China. Where am I going to see that happen now, Chris? What's the part of this market that I want to totally avoid because they're ramping up capacity over the last 12 months, and 12 months down the road, demand's not going to be there?
Well, there's two different things here. So let's just touch on one thing. Let's just talk about inventories. If you look at inventories, in some cases, and Target, to a certain degree, Walmart, have too much inventory on hand. This is the first time we're hearing about it. Not the first time. This is a stark difference than what we heard a year ago. And to what we think has happened is the Walmarts and the Targets got into a bit of an arms race with Amazon. Everyone grabbed workers. Everyone paid up for workers. Everyone wanted more warehouse space. Everyone wanted inventory. And then what happened is a consumer changed his or her behavior. One of the things you couldn't appreciate and was a shock to the system is what happened on the geopolitical side. Now to answer the other question of what you want to avoid, I think it's the same thing we've been talking about for some time. You want to avoid companies that aren't earning anything at this point in time. You don't, if you're managing on multiples of revenue and not multiples of earnings, the world has changed. That's not a good place to be, right? We took our short off, but we're not really positive on this, on things at this point in time. And let's just talk about something else. Let's talk about growth managers and value managers. If you talk about sentiment and you talk to a value manager, they're saying, hey guys, what's going on? Things are good. The capital markets are acting normally. Froth is coming out of the system. People are paying attention to what they're buying, and what you pay for something means something. You're being rewarded on how you decide to make your decisions, right? If you're a growth manager, the apocalypse is upon you. You're down 20, 25, 50%. Everything you're doing is going wrong. There is no place for you to hide. And so there was a lot of talk about forced selling, liquidations. You are seeing forced selling. You are seeing liquidation on the growth side. And we're seeing a very Darwinian event. There are too many growth PMs. There's too much assets dedicated to growth at this point in time, and we have to see a washout at this juncture. The last thing I would say is you are seeing opportunities opening up in growth because of that forced selling. People are selling things indiscriminately, and that typically opens up alpha stock selection opportunities longer term.
Chris, we've got a bit more time on this later in the show, but I just want to finish on this just to tee up the next segment with you. When I listen to you, it feels like this hasn't fully played out for some of these growth names. And when you think about just how mechanically challenged the index level might be because of that, can you walk me through the direction of travel here and how we get back to your year-end price target, if that indeed is the case?
Yeah, so I think you have to, there's a little bit more road to hoe, as you point out. There's going to be some tougher times. We're going to see numbers come down. But what we're talking about from the Fed and what the Fed is beginning to indicate is we front-loaded hikes, right? If we get to the end of the summer, the middle part of the summer, and we realize the Fed is now going to go 25 basis points at a clip, and maybe they won't be as aggressive, all of a sudden we can start making gains. And then what happens is maybe we've seen a high in bond yields, growth begins to work, you've washed out a lot of names. I will tell you what, we are beginning to see a lot more opportunity on the growth side today than we've seen in a long time.
Interesting. Chris, hold that thought. Hold that thought, because we're going to get a final word from you in just a moment. Chris Harvey, sticking with us. Coming up, Meta's Sheryl Sandberg stepping down.
You can't really say anything overwhelmingly positive or overwhelmingly negative about Sheryl Sandberg. She was an astonishingly effective leader who had a major blind spot.
That conversation coming up, and a final word, a final call from Chris Harvey of Wells.
I made a final decision this weekend and let Mark know. A decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation.
Sheryl Sandberg there speaking with Bloomberg's Emily Chang after announcing her decision to step down as Facebook's chief operating officer. Baird's Colin Sebastian running the following. Sheryl was a huge asset for Meta, but the company's shift in focus towards the metaverse means the time is probably right to hand business operations over to the next generation of leadership. Ed back with us for a little bit more. Hey, Ed.
Yeah, it's interesting, John, because the individual she's handing over to, Javier Olivan, is also a long-term Facebook, now Meta leader. He was vice president of growth more recently, prior to that vice president of core products. So they are keeping it in the family, so to speak. But you have to look at what Sheryl Sandberg's done over that 14-year period. When she joined in 2008, this was a fledgling social network and startup with a few 100,000 users. It's now a platform that accounts for 2/3 of the world's internet-connected population. They did $120 billion of revenue, principally from advertising, in 2021. I remember very clearly in July of last year being at Sun Valley and a New York Times article hitting that the relationship between Sandberg and Mark Zuckerberg had deteriorated. And then we had a very staged walk where the two of them, shoulder to shoulder, smiling. Since then, the question's been asked, was Sandberg due to leave? Especially now at this critical time where advertising is slowing. They're moving away from that model to a place where they sell more hardware and eventually services through that hardware to experience a virtual and augmented reality. We know it's going to take a lot of cash to get there, and it's going to be a lot of time until they make any meaningful profit from that business.
Ed, thank you. Thank you very much. Overwhelmingly, the conclusion that I've heard over the last 24 hours on this individual played a massive role in what this company is today. But as I said earlier this morning, within that, embedded in that, depending on what your perspective is, there is an insult or there is a compliment. You get to decide. Chris Harvey joins us now for a final word from Wells Fargo. Chris, I promised you this opportunity, the opportunities in growth. Where are they? Microsoft just pre-announced, the number's not fantastic. Run me through your call.
So John, this is not going to be that specific. What we want to do in growth is we want to find those stable growers or secular growers at a reasonable price. And we think you can find those in communication. We think you can find those in fintech. And we think there's a growing amount of companies that are beginning to emerge in the general technology space in semis. We are still underweight software. We think there's more downside to the software space or more underperformance. So that's not a place where we go to. But communication would be a place, fintech and semis.
Chris, you avoid the ad spend component. Can you do that, given what you've just explained?
Yeah, you can absolutely do that, especially if you focus on the fintech. What we want you to do is we want you to sharpen up your pencils. You're beginning to find these growth opportunities at reasonable prices. Now start working on the earnings. Now start looking 1, 2, 3 years down the road. Are these core positions for you? Do they make sense for you? And we're beginning to find a lot of value there. And to us, this is an emerging theme.
Chris Harvey of Wells on growth. Chris, thank you, buddy. Thank you very much. This with Microsoft very much in the focus this morning, falling, the stock down after pairing quarterly forecasts on a currency drag. How much of that are we going to hear? If Microsoft is feeling it, big multinational, given what's happening with foreign exchange, how much of that are we going to hear from other companies as well? And given how much is left in the quarter too, interesting. The stock's down about 2%, no big move here on that single name. For the broader market, about 22, 23 minutes into the session, we are negative 0.4%. Call it 1/4%, 1/3% on the S&P. The Nasdaq 100 positive, about 1/10%. A lot of attention on the commodity market. We were down hard earlier this morning. Now we're back higher by 0.7%. 116 on WTI, on Brent 117, even with an increase to output from OPEC Plus of 648,000 barrels a day in both July and August. From New York, up next, your trading diary. The next couple of days busy with payrolls Friday just around the corner. 25 minutes in, your market looks like this. We're down 0.4% on the S&P 500. No real drama here. In the bond market, 2s, 10s and 30s shaping up as follows. Yields higher yesterday at the front end. Again today on a 10-year, 292.95. Data decent in America. Looking at the ISM manufacturing print just yesterday. Looking at claims okay. And every time we see better data in America, what do we expect? More work from the Fed. Higher interest rates, higher yields and ultimately lower treasuries. That's the price action. Here's your trading diary. Factory orders of durable goods at the top of the hour. President Biden meeting with NATO's Stoltenberg at 11:15 Eastern Time. Secretary Blinken delivering remarks shortly after at 11:30. Bit of Fed speak for you. Lorena Mester and Lael Brainerd wrapping up a busy week of Fed speak. And finally, the main event. Tomorrow morning is Payrolls Friday. Your numbers look like this. The median estimate so far, 325K. Unemployment expected to come down from 3.6 to 3.5%. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, June 2nd. Here are the top market stories that we're following for you at this hour. Calming down the oil market. OPEC Plus may boost oil output in a surprise twist. The U.S. welcomes the decision. We're going to break it down with Jeff Currie, Goldman Sachs, Global Head of Commodities. And calming down the economy. Jobless claims fall. ADP rises less than estimated while Jamie Dimon warns of a hurricane. We try to piece together the economic puzzles ahead of Jobs Friday. And calming down inflation.
inflation. The White House tries to bring out all the stops to tame rising prices, from supply chains to semis to baby formula. We talked to U.S. Commerce Secretary Gina Raimondo in the 11 o'clock hour. From New York, I'm Alex Steele with Anna Edwards joining me in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Anna, it's kind of the theme, right? If we calm down the markets, if we calm down oil, if we calm down the economy and inflation, what's next? Then what happens?
Yeah, absolutely. Big questions that investors are dealing with, Alex. And in terms of where the direction of the U.S. economy goes, we've had some mixed signals, haven't we, in the last couple of days, if that gives us any insight into what happens next. Yesterday, we were dealing with pretty strong data at this time of day. That got the market thinking, well, maybe the Fed is going to be able to hike some more as anticipated. Today's data has looked mixed, and just right now, the data we've just seen hitting the Bloomberg also looking pretty mixed.
Yeah, you take a look at factory orders for April. A big miss there, coming in just up 0.3%. Also, you had March revised lower as well. Durable goods, if you back out in inflation, in transportation, I should say, came in up 0.4%. Mixed. All mixed. Okay, but mixed. So let's get a deeper dive into these numbers. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. Hey, Mike, the factory orders seems like a really big miss.
It's a bit of a miss on the durable goods side particularly, but we knew that because we'd gotten those numbers earlier in the week. Non-durable goods, clothing, etc., increased by 0.2%. So there is a real disappointment there. But these are orders. Shipments come in a little bit better, and inventories continue to rise. Inventories are up now for 20 of the last 21 months. They increased 0.6%. So it does show manufacturers getting us a little bit closer to normal. But again, as I've said many times, these are volatile numbers. They go up and down each month. And so I wouldn't put too much stock in it. Maybe more the idea that orders are up now for 11 of the last 12 months. That may be the more important number or thing to keep in mind. The economy's still going.
Yeah, given so many concerns about the consumer and its ability, the consumer's ability to keep buying durable goods, I suppose, and have the appetite for big expenditure, Mike, maybe the fact that that number has not collapsed, maybe that's something of a positive. Let me ask you about something that doesn't look so positive, and that was the ADP data. What clues are we getting from the private sector and its ability to create jobs at this point as to what the US economy looks like right now?
Well, Anna, we've been expecting a weaker payrolls report tomorrow from the government, and this just sort of backs up the idea. The question is, are companies still in a full court press to hire, and can they find people to do so? The ADP report would suggest there's a problem with that, although it is, as you mentioned, only private sector, so we'll have to see the difference between that and government tomorrow. And also, it has run about 150 to 200,000 below what we've seen in the payrolls report. So yes, it does suggest a slowing labor force, a loosening labor force, but the Fed kind of wants to see that. We also got jobless claims, and as you can see, they're weighed out still at 200,000, and the continuing claims number, the smallest since 1969. So if the labor market is loosening, it's only loosening a little bit, and we know that ADP doesn't have a great track record. So at this point, it's too early to say that the Fed's having an impact there.
Okay, Mike, thanks very much. Bloomberg's Michael McKee with analysis of the latest data that we're getting today. Let's get to our question of the day. Have we hit peak volatility? We ask this because a lot of the data we've seen today has been pretty mixed. We've seen war start on the continent of Europe. That is still ongoing. We've seen China, of course, loosening some of its controls in its fight against COVID-19. What does that add up to for volatility? Have we seen peak volatility? Let's ask Amy Wu-Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. So have we peaked on volatility, Amy?
Well, if you look to the options market, the answer is yes. So one thing we look at is what is future expectations for volatility compared to what has happened in the past. We refer to it as the volatility risk premium, and that spread is really at historic highs. So the market believes the future is going to look a lot calmer than it has in the past.
Amy, are there any positions being taken on to protect against that thesis not actually working out? Or is now the time to actually buy cheaper options to protect?
Yeah, it's a great question, Alex. And, we've been joking, like the honey badger, volatility just doesn't care. You've seen really no demand for hedges. You've seen no demand for downside protection. There's a lot of narrative around why that's true, but you know, you hear Jamie Dimon talking about a potential hurricane in the future. Is the options market priced for that hurricane? Absolutely not. The demand for tails, demand for crashes, either to the upside or the downside, is not there. You know, the market thinks that it's going to be calmer waters going forward, and that's coming off a really high absolute level in the past.
When we look at measures of future volatility, Amy, that you're talking about, and then realized volatility, what we actually see in the markets, I mean, how good have we been this year at predicting what volatility will look like? Because this year has been pretty unpredictable.
Yeah, I would say, unfortunately, we've been pretty bad. And historically, volatility does tend to be a pretty good predictor. I would say that hasn't been true. And part of the reason is there's been a lot of unknown unknowns in the sense that, you know, look, of course, we all knew that the Fed was going to be less accommodative. We've known that since last year. But did we really believe there was going to be a war between Russia and Ukraine? The answer is no. And all the things that kind of led from that. So I think the factors of the unknown unknowns has made it difficult to price. And, you know, another example of that is we've been hearing about the potential for this port shutdown, this port strike. I think everyone believes that is very unlikely. But look, if something like that happens again, then here we go again on a volatility roller coaster. Again, extremely challenging to price those unknown unknowns.
So if it's hard to do it on a broad volatility basis, Amy, we have seen individual stock volatility really pick up. I wonder where that is now and what that tells you.
Yeah, it's been very stratified, Alex. So I'll give you one example. Amazon, for instance, has really been behaving the opposite of the market. We've actually seen volatility increase as the stock price has also increased. That skew inversion, which we historically only saw during the pandemic, and part of the reason is investors are actually playing for a stock split. So, you know, that's a situation where actually owning near the money calls and selling further out the money calls on a leverage basis actually makes sense, whereas it doesn't necessarily on an overall index level. And we're also seeing inflection points in China, inflection points in the bond proxy ETFs. So I think what is happening is investors, you know, maybe they're less participating in the market overall, but you're doing that stratification on the single stock sector level.
One of the things that's led to so much volatility in stock markets, Amy, has been what we've seen in sovereign debt markets. And I wonder what clues you're getting in that market as to the path ahead.
Yeah, it's funny because, you know, I think the fierce debate between myself and my fixed income colleagues is, well, who actually leads who? This year, actually, I think, yeah, you know, I think the debt market has actually been the leading indicator rather than the equity markets. One proxy that we use there to be helpful is the MOVE index compared to the VIX. And that actually has been pretty forward telling. So I'll call it 2 months ago, you know, that was flagging extreme volatility that we then saw bleed into the equity market. But now that ratio, they have both normalized. So essentially both things, both factors are saying calmer waters ahead into the summer.
Okay, let's look at it on a factor level. Amy, some say that the value trade has now been played out. Some say that growth is finally cheap enough. And I'm wondering, the options market, are we seeing anything to that point? Like, are we selling puts on value, buying calls on growth? Like, have you noticed anything on a factor level?
Yeah, it's a really good point. I'll tell you two things to be aware of. The first is because of what has happened in terms of, you know, essentially that growth rotation to value, a lot of names that you would consider now being momentum or growth are actually names that historically were value, if that makes any sense. So, you know, your energy has been a winner's win situation. If you actually look at the definition of the MTUM, you know, that has actually flipped in terms of the characteristics. So what I would say is while you're seeing factor trades, the underlying stocks are actually completely different sectors than they were 6 months ago. Now, that said, you know, we did see a lot of that in IWM. We saw that in QQQs as a proxy for hedges. You're not really seeing that now. There has not been as much distinguishing in terms of those. It's been more in, as I mentioned before, the bond proxy ETFs, China, and then a little bit more on the macro level.
And on a sector level, Amy, where are you seeing options markets expressing most concern?
Yeah, in terms of where we see the concern, it's still in the consumer. And interestingly, it's not really in energy. It's more in your XLY, the consumer discretionary parts of staples, XLP, even though arguably, I would say those have played out. You're still seeing elevated relative concern there. And I think that, a lot of that speaks to the data points that we'll be getting soon, not only on inflation, but payrolls and people wanting to play those specific data points as they come out.
Hey, Amy, it's always good to catch up with you. I love your insights. Your weekly notes are like a must-read for anyone out there. Amy with Silverman, RBC Capital Markets, Managing Director and Equity Derivatives Strategist. Thank you so very much. All right, coming up, let's talk some volatility. How about Meta? What Sheryl Sandberg's departure means for Meta investors. We're going to speak with a shareholder, Mark Stokel, Atom Fund's CEO, coming up next. This is Bloomberg.
May jobs are in focus.
There are 11 million open jobs.
And you wonder how that folds into the future of the American labor economy.
Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is starting to get a little easier.
95% of the jobs that were pre-pandemic have recovered.
Because there's more resiliency in the economy.
The May Jobs Report, Friday on Bloomberg Television and Radio.
Facebook investors are trying to decide today what Meta Platforms parent will look like without Chief Operating Officer Sheryl Sandberg. The stock is up 2% now, but over the last 2 days, it got hit a bit. She did help turn Facebook from a startup into a multi-billion-dollar advertising powerhouse, and now Sandberg's calling it quits. Want to bring in Mark Stokel, the CEO of Atoms Fund. Meta is one of his top holdings. Also, Bloomberg Tech anchor Emily Chang, who had an exclusive interview with Sandberg on her announcement. Emily, I just want to start with you. What was some of your biggest takeaways in terms of your conversation with her? How did it come about? Why now?
So, look, I will say this is the end of a Silicon Valley era. I mean, Sheryl Sandberg leaving is a big deal. She scaled not just Facebook's business model, but Google's business model, and really pioneered this whole idea of personalized advertising. Now it is controversial, and I would think that Sheryl Sandberg probably has wanted to leave several times over the last several years, but it's never really been a good time because Facebook has weathered so many controversies, and she has often been the face of those controversies. But if you think about it, the metaverse may have been kind of like an exit ramp for her, because she basically has to come up with a whole new business model. And nobody knows for sure what the metaverse is or if Facebook can be the one to lead that future. So one of the questions I asked her is this in part because of the metaverse, and do you believe in it? Is it just too hard? Do you not know what to do here? And take a listen to what she had to say.
We have a current business, which is our current apps connecting customers to businesses. And I think there's a lot of opportunity there right now, but also over the long run. And then the metaverse is a much longer term business opportunity. And it's going to take some of the same form. And I believe we will be a place, and then the metaverse will be a place where businesses and consumers connect. But I think the exact form that takes is something that will be figured out over the next number of years, much longer term.
And now it's up to the rest of the team, Alex, to figure out what that business model is, and many of the people who are going to be stepping into the vacuum that she leaves are longtime Facebook lieutenants. They've been there for years, so, it's not necessarily an abrupt transition, but I think it certainly is symbolic.
Emily, good to see you. And I've been thinking a lot about the lean-in aspect that Sheryl Sandberg, of course, she wrote about women in business and how that's fitted with the careers of many of the women that I know and that I've watched. And I know that she's going to be doing something more on that front. Do we know much more about what she wants to do from here?
So I definitely tried to get more from her in terms of what are you going to do next? And she talked about her philanthropy. She talked about women's advocacy. And as you mentioned, this is a moment for women, potentially she wants to get more involved in the Roe versus Wade dispute and what happens there. She also wants to spend more time with her family. I did ask, but are you going to take another role in business? Are we going to see you try to get into politics? She said all of that is pretty unlikely, but, joked that she, would never say never. And let's remember, she is staying on the Meta board. So take a listen to what she had to say just in terms of the why and why now.
This was a decision I made that I did not come to lightly, and it really is about how I will spend my time, not how much I believe in the company. I believe in the company every bit as much as I ever did, and staying on the board. And I really have complete confidence in the team Mark and I have built. I think they're going to do a great job building the future for a company that's a huge part of my life and a huge part of my heart.
And of course, we'll see how long she stays on the board, and we'll definitely be watching what she does next.
Yeah. It was a great interview, fascinating stuff. Mark, I want to bring you in on the shareholder front. Meta is one of your biggest holdings. 191 is where Facebook is sitting right now. Your thoughts on Sheryl Sandberg leaving?
Well, I think it's important to say that she did this about as elegantly as you can do it. I think Emily's absolutely right. There's no good time when you're as important a person as she's been to Facebook for as many years as she's been there. But from our perspective, we do take a lot of comfort in the fact that it is a good bench. She's talked about that. She and Mark have both talked about that. But I think that Emily brings up a pretty good thing. I keep thinking about what is she going to do next now that she's kind of retired, and I keep coming back to Tom Brady. I think she's going to unretire at some point. I think she's a very talented woman who could be a CEO, as Emily said. She could go into politics. She's very close to Larry Summers, and I think she has what it takes to do a lot of different things. Or she may just stay with the family and do philanthropy, which is also admirable.
Mark, thinking about her role at Facebook, as was Meta, and where she leaves this business. I mean, she's clearly somebody who knew how to monetize technology, and that is not the case for all tech businesses, as we know. So we've all learned a lot from watching Sheryl Sandberg and what she's done, but at what cost, and what kind of regulatory headwinds does she leave behind for this business?
Well, that's a really good point. I mean, I think that she has taken the brunt, frankly, so at least the front-facing brunt of a lot of the issues at Facebook. I do think that when you think about where Facebook is from a regulatory standpoint, it's still in sort of no man's land. We don't know what's going to happen. There will be continued pressure on them in some regard. But I come back to her, and I think you can actually say she's leaving on top. Certainly there are some issues with this, but there are always going to be issues when you go from the small company that it was when she joined 14 years ago to the company it is today. The amount of cash flow that this company generates, and that's really one of the things that we key in on is the amount of cash flow that this thing generates, this company generates, and the fact that they can do what they do, still have money to be able to invest in the metaverse, which they are clearly pivoting to. We think that there's a strong enough bench. We do. We're not naive to think that there aren't some regulatory headwinds, but we do think that they are manageable, and Facebook has managed them at various times before. So the valuation, the gobs of free cash flow that it generates really does, to us, really wind up to a company that we think is still a very good stock.
Mark, I hear you. I'm just wondering how you reconcile then the slowing user growth, the slowing ad sales, the regulatory overhang in Europe, for example. We don't really know the revenue hit that Facebook's going to take from Apple. How long would you be sticking with this story?
Alex, I got to tell you, that's a really good question. We talk about that a lot. We will need to see in their next 2 quarterly reports how much progress they've made. The Apple was a big deal. TikTok has been a big deal. But at the end of the day, and we've spent a lot of time talking to advertising agencies, at the end of the day, don't forget that the best return on investment for advertisers is Facebook. The shiny new toy in TikTok is great, and we believe that TikTok is taking share from places other than Facebook. But at the end of the day, it continues to be the best return on investment for advertisers, and with $2 billion daily active users, that gives you a lot of runway to do good things.
Remind us, Mark, let's pivot slightly and stick with tech, though, of course. Remind us if you own Microsoft. We had some numbers through from Microsoft, some guidance for the fourth quarter. I wonder how that sits with you.
Well, it's interesting. So it was FX is the issue with Microsoft today, and let's try to put it in perspective. It was a 3 or 4 cent hit on about a $2.20 number. So it really is pretty small. And from where we sit, Salesforce the other day talked about FX headwinds. Other tech companies have talked about FX headwinds, but they haven't been as small as a hit as they are to Microsoft. So we believe that Microsoft is handling this better than most tech companies when it comes to the FX hit that they talked about.
I love working from home. Lights automatically go out.
No, honestly, this is in my office. And
we feel you. It's all right.
Technical difficulties.
We've all been there. Emily,
sorry about that.
No problem. Emily, just to wrap up, I just feel like the news from Microsoft in some ways epitomizes sort of the struggles that tech is going with. A lot of other companies are sort of freezing their wages or rescinding some hiring or freezing their workforce, et cetera. What are you hearing from CEOs in terms of how they're feeling right now?
Yeah, I think, if you look at Microsoft, obviously they're not immune to macroeconomic forces, but they have the stability in Satya Nadella, and we have seen the market cap go from $1 to $2 trillion under his leadership after languishing for years. And I think the leaning into the cloud has been very good from a business perspective for them and strategically for them. But yes, all of tech is facing these headwinds. And I would push back a little on what Mark had to say because, I think you're seeing Facebook in kind of an existential crisis right now when it comes to the business model. And it's not just TikTok, but yes, TikTok is taking share from Instagram and is potentially taking future ad dollars from this big platform. And is the metaverse going to be a thing? And is Facebook going to own it if it is a thing? And is Facebook going to be able to make money in it if that is the future? I think those are all big open questions. So all of these companies face, specific, company-specific challenges, but then they're all in the middle of this macroeconomic environment, which is very difficult and very unpredictable.
Okay, all I know about the metaverse, Emily, is all the images I've seen of it, nobody has any legs, which I find very weird.
Just ask your son.
So we'll see how big it does get. Very spooky. Mark, thank you very much. Mark Stokell, Adams Fund CEO, and Bloomberg's Emily Chang, thank you so much for joining us as well. This is Bloomberg. Coming up, we'll look at trends in M&A. Mark Cooper, CEO of Solomon Partners, joins us shortly.
Moment. People were talking about that all day yesterday.
We're an hour into the U.S. trading session. Lael Brainard just speaking earlier, talking about the financial conditions and how they have tightened, and says, look, 50 basis point hikes over the next couple of sessions will be, the next couple of meetings make sense. It's hard to make a case for a pause in September. Saying it's hard to make a case for a pause in September. So a little more hawkish there from Lael Brainard. Bloomberg's Abigail Doolittle now is tracking all of the moves within the equity markets. A little softer today.
A little bit softer, Alex, indeed. And it seems that those comments helping the S&P 500 to go near session lows. Now, this is an intraday chart of the S&P 500 E-mini futures and Microsoft, because prior to those Lael Brainard comments, we had Microsoft's bearish pre-announcement for the fiscal fourth quarter to the downside. And earlier, you had the S&P 500 E-mini futures higher and then taking a big leg lower. Right now down about 0.5% on that pre-announcement, having to do with FX, currency headwinds, according to the company, and most analysts seem to be accepting that. But let's see if that is the case as the quarters continue to tick on. Or if currency headwinds continue to be a problem, that would be an inflationary signal. But the S&P 500 trying to recover and then going back down on those relatively hawkish comments from Lael Brainard around the idea that that flexibility that we were hearing about last week from the FOMC minutes from the last meeting, well, it seems like less so. As for some other movers on the day, let's take a look at some of the stocks on the move. And here is Microsoft down 2.5%, of course, on that bearish pre-announcement. So not a huge move to the downside. Investors and traders giving the company the benefit of the doubt that it is FX and not an issue around enterprise demand. However, you can see HPE, on the other hand, down 6.8%. Their outlook relative relatively weak, and that is true too for AI. This is down 17%, and their outlook having to do with the fundamentals as well. That's just not there in terms of taking the outlook down. However, we do of course have oil not down but higher. It had been down earlier, but higher now, up about 0.9%, and overnight it had been down, and then coming back on the idea that there could be an increase in output. Well, we got that increase in output, a 50% increase from OPEC plus. But it's interesting, Anna, investors simply don't care. They think maybe the summer demand for gasoline, who knows what it is, but that output, that bigger than expected output increase from OPEC plus, not denting oil for very long. Again, up 0.8%.
Yeah, absolutely. So a bit of volatility created there. Bloomberg's Abigail Doolittle with a look at the markets. And talking about volatility, we've seen volatility taking a toll on capital markets activity, on all of the plans to raise money that global businesses have had over the last couple of months. Some of those have been put on hold. I have a chart here that talks about IPO activity, bond market activity, raising money through loans, doing M&A, and the rate at which those types of deals, those types of activity have been delayed, Alex. And this is a running tally of the number of deals that have been delayed or indeed cancelled. That has increased, and it's increasing at quite a rapid rate. So we started this hour talking about whether volatility had peaked. Maybe that gives us a break from this trend, but certainly we've seen tough times over the last couple of months, Alex.
Yeah, such an interesting chart and such a good question in terms of peak volatility and the aftermath of that. So wanted to get that view even further right now from Mark Cooper, CEO of Solomon Partners. Mark, it's always good to get your perspective, and Anna's chart was so interesting. It just showed the amount of deals that were pulled, whether IPO or M&A, you name it. Are we at peak volatility? And then does that chart look different in 4 months? Do things get better?
My judgment says we're not at peak volatility. My judgment says there's too much uncertainty in the marketplace. There are too many things happening. Either it's the Fed reversing QE2, it's the war in Ukraine, it's interest rates going up and how much they'll go up. There's just too many unknowns, too many big items out there that is what creates volatility in markets. Markets like certainty, they like clear direction, and with free-floating anxiety, that's what creates ups and downs.
Sorry, I was just going to say, Mark, you've talked about some of the headwinds then that those that want to take part in capital markets activity are facing right now, that want to go out there and raise money. What happens if earnings start to turn as well? Because so far, give us your thoughts on whether earnings have held up or not, but if they have, that could be another leg down if that starts to turn.
So that to me, that's the big one. And the big one is when do earnings fall? Because right now it has been pretty good. We talk a lot about recession. We talk a lot about headwinds for companies. We talk a lot about the headwinds for the consumer, but the consumer has been darn strong. So earnings are good and companies are doing well. The question is, what's that going to look like in 6 and 12 months? From an M&A perspective, I would bring it back a bit, because interestingly enough, the market is pretty much flat year to date versus 2019. And that's an interesting comment. 2020 obviously a lost year. 2021 was the year of the decade, or the multi-decade in terms of transactions. 2019, good year. And we're pretty much flat. So there's more activity going on than you'd like to believe, and there's a lot of interesting reasons. Despite your chart, which talks a lot about the public markets, the private markets have been pretty aggressive, both in terms of equity capital that they're putting to work, and then debt capital, which is the interesting new phenomenon in the marketplace, which is private debt capital is still fueling a private equity acquisition market.
Mark, how long does that last if the Fed continues to hike? Lyle Brainerd just talking about how 50 basis points for the next 2 meetings feels like a given. Hard to make a case for a pause in September. It's basically saying that financial conditions will continue to tighten. Can that scenario you laid out continue?
Yes. It's not interest rates. I mean, we talk a lot about interest rates, but keep in mind where we've come from. We've come from 0. We go up 200 basis points, we're at 2. So we're still talking about interest rates, even with the spread that the private capital takes, it's still relatively low to the history that we're used to. I was telling a friend, I remember back in 1986, I had a mortgage at 10%.
Yeah.
So this is looking darn cheap. So I don't think it's the interest rates per se that would put a hamper on it. What I do think, and by the way, private equity will have to take lower returns, of course, because they'll have less free money, but maybe they're paying lower prices, so it works. I think the issue is, what does, and this is the comment you made a moment ago, what does interest rates do to the consumer? How do interest rates and how does the tightening of the Fed, how does that affect corporate earnings? So that, to me, is the bigger question as to what would have a negative impact on transactions.
And you do a lot of business, Mark, in the retail space, in consumer-facing businesses. What are you seeing there, then, to your point about how the higher interest rate environment weighs on the psychology and the higher inflation weighs on the psychology of consumers?
Well, amazingly enough, people are buying. And you've seen the numbers come out from Macy's and others, and people are buying. And and you've heard it from Jamie Dimon, you've heard it from Brian Moynihan. Their clients are healthy. They're cash rich. They have low loan to value on their houses. So they're feeling pretty good and they're spending. Now maybe they're going more experiential than they are going clothing now because they can get out. So they're doing well. But here's the issue. The issue with consumer companies is supply chain. Mm-hmm. Can they get the product in? And so most of our clients in the consumer space are having their issues with not having the product to sell. So that's been the challenge. And I do think that challenge will continue for some period. I think the supply chain issues will work themselves out. Now, they might work themselves out at the point when the consumer turns around and says, no more. I'm gonna hunker back because I've got to pay for this, rising inflation in my staples, and so they stop spending on discretionary.
Yeah.
But so far so good.
Hey, Mark. Aside from the consumer retail space, what is the most active area that you anticipate over the next few months?
We're seeing it across the board. I mean, there are a lot of what people would perceive as being less recession or more recession-resistant areas. Healthcare continues to be one. We've seen some of the big trades in technology, and while valuations might be changing, everyone still believes over the long term technology is the place to be. We have some sub-segments that continue to be important. We have an interesting business services unit that provides vital services to both residential and commercial customers that you can't get away from in a recession, and they seem to continue to do quite well. I think the big shift we're seeing from last year, among others, because there were a number of drivers of last year's run-up, but the big shift is last year even the tough deals got done. This year, it's more like the great deals are getting done, they're getting done at good values, they're going rapidly, and you're suffering with some of the ones that have more, let's just call it, hair on them.
Okay, Mark, thank you. Interesting place to leave the conversation. Thanks for that. Mark Cooper, the CEO of Solomon Partners, thank you so much for joining us here on Bloomberg TV. Coming up then on this program, OPEC Plus is opening up the taps. It's increasing the size of oil supply hikes. We will talk about what that means with Jeff Currie, Goldman Sachs Global Head of Commodities Research. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The US Supreme Court is facing a historic case backlog. The court is due to issue 33 opinions, 53% of its expected total in the final month of its current term. That is the most in percentage terms in more than 70 years. Amongst those are rulings that could effectively outlaw abortions in 24 states and put more handguns on the streets. OPEC Plus has bowed to pressure from major consumers to ease the pain of high energy prices. The coalition has agreed to increase the size of its oil supply hikes by about 50% in July and August. Still, the actual supply boost could be smaller than the official figure because some OPEC Plus members are unable to raise production. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's get more on oil here with Jeff Currie, Goldman Sachs Global Head of Commodities Research. Jeff, it's always a pleasure to talk to you. Okay, so you get increased output. Market wasn't really expecting it. OPEC Plus stays together and the oil price goes up. I don't get it. Explain it to me.
It doesn't really materially change anything. When we think about what they did, they compressed 3 production hikes into 2 months. So it doesn't really change the terminal level of production. And the market tried to price in a much bigger terminal level of production over the last several days. And so what you're doing is you're getting a rebound rally back to levels where we were before a lot of these rumors hit. I think the key message here is that as you distribute potential Russian supply across other members of OPEC, they can't even hit their quota right now. So they're already significantly constrained in their ability to increase, with the exception of Saudi Arabia and UAE. And so when we think about how does this change the fundamental picture when we go to September, October, it really doesn't do anything, and that's why the market's rallying.
Okay, I mean, good to see you, Jeff. Does more oil more quickly not make any difference, I suppose, at the margin, or the symbolism of OPEC Plus doing something different from what they'd originally planned, even if it's just different by calendar date? Does that make any difference at all in terms of the sentiment around oil?
It probably means an extra 100,000 barrels per day during the months of July and August, which is in a 100 million barrel per day per day market is minimal. But I think the concerns around the disintegration of OPEC Plus and so forth, I think a lot of those worries can be dismissed at this point in time, and that the market is still being well managed. And the one thing about this group is they're very transparent and very data dependent. And so, if the market changes, the bottom line, this market was in a surplus during the months of April and May. The hit out of China was a recession to oil and all commodities. Remember, China was at the margin, the biggest consumer, and it contracted materially during April and May, and as a result, inventories built. So, is this market in, a shortage position today? No, but is it likely to be as we look out towards the end of this year? Yes.
Jeff, let's talk about the demand side for just a second. I was talking to Ed Morris of Citi earlier in the week, and he was much more pessimistic on demand going forward. He thought that fair value for oil was more in the 70s. Make your case for the fair value in terms of the supply and demand picture.
Well, I think, first of all, let's look at the level of inflation, not only across the global economy, but within the oil sector itself. The cost structure is moving up $80, $90 a barrel. So if you're even talking about where a new equilibrium is, it's much higher today and rate rising by the minute. But I think when we talk about the outlook going forward, let's point out, this market was dealing with a commodity recession in the form of what China was contracting due to the lockdowns in Shanghai and the surrounding areas during April and May. Global oil demand contracted by 2.5 million barrels per day. What does the outlook look like going forward? China's coming out of lockdowns right now, and they're stimulating. So you can think about China's got one foot on the brake, the other one on the accelerator, and is about to take the foot off the brake. Then we throw on top of that a very strong travel season. People haven't gone on holiday for 2.5 years. You can already see it in plane bookings and bookings throughout, driving and everything else. And then finally, you have Russian production materially getting tighter over the coming months. So you put it all together, this market's going to get significantly tighter as we look out towards the summer months. Our target is still $125 a barrel, but there's a lot of risk to the upside.
A lot of risk to the upside and gets tighter over the summer. But how long does that positive influence, Jeff, come from China? Because, yes, China is opening up in various places, but, you know, maybe only until they shut down again. How sure can you be that we are on a course that looks more positive from an economic sense for China?
Oh, by the way, that is always a risk that, you know, that they lock down again. But I do want to emphasize that, you know, they're shifting their focus towards more testing. The economic implications and the civil unrest that the significant lockdowns on Shanghai created means they're unlikely to repeat that again. You know, maybe you could see, you know, right now we would put demand down somewhere around 1 million barrels per day relative to the 2.5. You know, you could see that not coming back in your rolling lockdowns. But the reality of us going back to another 2.5 million barrel per day demand loss is extremely unlikely. Let's look at, you know, the PMIs were the worst since February 2020, and, you know, metals demand was down 10%. I don't think we're going to see a repeat of that. And then you look at the amount of stimulus in the system. You have the, you know, the party Congress in October. They're going to want to see growth going into that. You know, it may not reach the targets people want, but there's going to be a lot of acceleration out of China between now and the autumn.
Which kind of begs the question, Jeff. Like, it's great if OPEC Plus is going to increase their quota, but like you said, they're just bringing forward that supply. What part of the oil market is the tightest? Like, what product or what grade of oil? Like, where are we going to see the biggest stress?
I think that is the right question to be asking, Alex, because, you know, when we look at, you know, refining capacity, we're short refining capacity. And that's one of the points that, you know, the OPEC member states make, is this is not about oil production itself, but about the refining capacity to process that oil production. You know, you look at jet fuel was trading near $300 a barrel. You know, distillate, you know, went off the board last month somewhere around $220 a barrel. You look at, you know, where we're trading right now. Given where the cracks are, we're trading an equivalent of $140 a barrel. And it's the entire, you know, across the board. And the parts where we're really short are, you know, the heavier, medium sour grade crudes. And, you know, things like shale don't produce a lot of middle distillates in jet fuel. They're not going to solve the problem, you know, because those are those medium sour crudes like Russia produces are the ones that we're short relative to the quality of the refining capacity. But let's not dismiss the lack of refining capacity out there. The U.S. has shut 1.2 million barrels per day refining capacity over the last several years. And then you also have, you know, big maintenance programs.
So, Jeff, does that limit the ability of the Biden administration when it visits Saudi Arabia to call for more production once again on top of what we've heard today?
Yeah, absolutely. You know, and I know the response back from Saudi Arabia, we can do what we can on the oil production side, but there's a refining capacity problem. By the way, this is the revenge of the old economy. It's not just refining capacity, it's everything in the old economy. Metals, mining, all of these sectors are underinvested and don't have significant capacity. You know, there's a view that you're going to resolve all of these supply chain bottlenecks, you know, mysteriously. The reality is it requires investment. And it's capital we're not seeing going to any of these sectors right now. People still do not like the old economy.
Revenge of the old economy, doing things in real life for a change. Jeff, thanks so much. Jeff Currie, Goldman Sachs, Global Head of Commodities Research. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Anna Edwards in London with Alex Steele over in New York. Sticking with North America, some breaking news across the Bloomberg terminal. Bank of Canada is indicating that the policy rate may need to move past 3%. We heard from the Bank of Canada yesterday, hiking by 50 basis points. Some hawkish commentary to go along with that, so some further reevaluation of where we go on the hiking cycle, the global hiking cycle then, from Canada with its input once again today. Let me get to where we are on European equity markets. We are without, of course, the London market today. No London today. No London tomorrow. The UK market is closed for the Platinum Jubilee, a celebration of the Queen on the throne for 70 years. But we have other markets in Europe that are open. This is the CAC 40 over in Paris, up by just over 1%. Some of the construction names doing pretty well over in Paris right now. Brent crude down 0.5%. A lot of volatility in oil prices, it seems, today on expectations of further production from OPEC Plus. We got it, but then we saw the Brent crude price move around quite a bit as a result of that. The pound up by 0.4%, but really that is dollar weakness, just reversing some of the dollar strength that we saw on risk aversion attached to strong data during yesterday's session. Coming up next on this program, in the next hour of our programming, the European close, of course, we will talk to Mari-Elke Pangestu, Managing Director of Development Policy and Partnerships at the World Bank. We will talk about food prices, a food price crisis. We will talk about mitigation, things that can be done to take that on. That conversation coming up shortly. We'll also get to the close of European equity markets. No London, so slightly lower volumes than normal. But of course, we have plenty of markets that are open. We will close those for you in half an hour. This is Bloomberg.
This is Bloomberg.
It's Thursday, the 2nd of June. Slightly lighter volume with UK markets closed today for the Platinum Jubilee celebrations. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Welcome to the European Close. European equity markets then set to close in half an hour's time, so let's get you a market check. And we are without London. No volume going through in London today because it is a public holiday, a very long weekend, many people off and celebrating. So no doubt the pubs and restaurants are going to be busy. A lot of people taking the opportunity to go out and travel as well. But there are plenty of markets that are open in Europe, so let's get to some of those. The French market doing pretty well today, up by just over 1%. Construction seems to be a positive theme. We heard from Saint-Gobain, that's a big construction company over in Paris, and that has added to some sentiment, positive sentiment around that sector. Brent crude actually up now by 0.3%, so pretty volatile either side of the flat line, keeping us guessing how much the market is reading into that, bringing forward of output hikes for OPEC plus. That seems to be the takeaway from talking to Jeff Curry. His view was that it didn't make all that much difference, but the market oscillating between gains and losses really for Brent compared to the previous close. The pound is up by 0.4%, but really this is quite a lot to do with Alex, dollar weakness. That's the other side of this, of course. We had seen the dollar gaining this time yesterday on the back of that sentiment that we were going to see the Fed hike a lot because of the strength of the US data. Today, the data looked more mixed, and so as a result, other currencies get a chance to rally. Alex, what do you see in these markets?
Let's talk about the mixed data here because we have some micro and some macro happening. So on the macro front, we got some mixed unemployment data, your jobless claims falling, ADP, though, not as good as estimated, factory orders coming in a little weaker, durable goods coming in strong. Go figure. All of that kind of leading to indecisiveness when it comes to equities. The S&P now relatively flat. Lyle Brainerd, though, talking about how the Fed tools are very effective, saying that the next two meetings, 50 basis point rate hikes, it seems like a done deal, but then in September, they just don't know, but they don't see enough for a pause. But the 10-year yield goes nowhere. Flat, flat, flat. Now, the micro stories and the idiosyncratic ones are really happening in tech. Hewlett-Packard Industries Enterprises reported it's trying to reduce its reliance on sales of hardware, but they had an issue with their full-year profit forecast. In part, they cited FX movements, something very similar when it comes to Microsoft. That's not getting hit by that 2%, lowering its own outlook because of an FX currency drag. So that's sort of the macro and the micro happening here in the market, Anna.
Okay, let's get back to the macro and where the rate story goes globally. Alex, we talked about some of the comments coming through from Lyle Brainerd, a little bit more hawkish there. Let's get to the ECB conversation because now we see, and I've got a chart that illustrates this, that markets are now baking in bets that the ECB will hike rates by 0.5 point in December. And the way that we get to this, we've got on here on this chart the ECB, the Bank of England and the Fed. The way we get to this is, of course, the market is already assuming 25 plus 25. That takes us back to 0 for the ECB policy rate. That's what Christine Lagarde has flagged out to the month of September. But when you look to the year end, the markets are now factoring in that we get to 50, which means that the markets think there's a possibility, or pricing in now, the possibility of a 50 basis point hike in the month of December. And that would be quite a big deal because we don't see half-point moves from the ECB very often. The ECB last raised rates by 0.5 point back in the year 2000. What does all this mean for volatility? That's been one of well, it's been our question of the day that we've been asking today. Have we hit peak volatility? Let's ask Barrington Pitt-Miller. He joins us from Wickham Overseas Advisors, where he is the CIO. Barrington, nice to have you with us. We'll get back to the ECB specifically in a moment, perhaps. But in terms of this question of the day around volatility, we've had one guest today saying we've seen peak volatility, somebody else saying no, we haven't. What's your view?
Good morning. I think we are concerned that the rate expectations have the potential to continue to rise both